ladies and gentlemen, it's no secret that I think that the healthcare industry as a whole is going to be growing a lot over the next 10 to 20 years due to the fact that we have both an aging population, a growing population, and longer and longer life expectancies as time goes on. With that, you tend to have a greater need for different healthcare services, whether it be hospitals, long-term care facilities, and anything in between. So with that, I'm looking a little bit today at Omega Healthcare Investors, since this is a healthcare properties REIT. As you know, I like investing in healthcare properties. I have a stake in one of their competitors, Medical Properties Trust, and I'm definitely interested in whether this company and its nice beefy almost 10% dividend yield are a value today. And if they are, I could very well see myself purchasing some shares or possibly selling some puts. So when it comes to that dividend, they have definitely been growing it steady over the last few years. So that seems to be moving in the correct direction, not at like a breakneck pace or anything, but they are going up, and up is better than down at any rate. And I always like to take a quick look at what specifically they do, because even amongst REITs there can be a little bit of variation. And it seems as though they simply offer triple net leases, which is pretty standard, but they also do offer fixed rate mortgage loans to some operators in the US and UK. So that's definitely something to look at, and immediately makes me curious what their balance sheet looks like, which we will take a look at momentarily. Now, their portfolio at a glance, 900 properties, 65 different operators, so some diversification, at least with the number of operators. Potentially, no single one of them would be a make or break situation, but all the same, you would hope that they're not having too many problems with their operators paying them. And when it comes to the balance sheet, looks like the mortgages that they issue make up about $1 billion of it, which is a little over 10% of their total assets. Speaking of their total assets, they have decreased year over year, while their liabilities have slightly increased, and shareholders' equity has, as a result of that, taken a bit of a slashing from $3.9 billion down to $3.6 billion. Now, if you remember, their market cap was $6.3 billion. Now, generally speaking, for something to be showing signs of undervaluation, you would want the market cap to be below this equity, because theoretically, if they were to liquidate everything at its face value today, and wipe out all their debts and liabilities and trade in all their assets for cash, this would be what would be left over to distribute amongst shareholders. Now, that's $3.6 billion, but the shareholders currently have $6.3 billion tied up in their shares at current prices. So shareholders would take a hit in that instance, right? And the reason you want to see a discount if you're looking for value is because you obviously you don't want them to be in a position to liquidate. That's not necessarily the point, but if they've got excess assets over and above what you're paying for, it gives you somewhat of a margin of safety, I think, on your investment, right? Because it means, hey, they've got room to, if they get into a bind, to sell something off, if they need to, add some cash. Cash is the lifeblood of any business. It gives them some breathing room to, steer the ship the right way and get things going if they need to. I don't feel like we've really got that so much here based on how little equity they have compared to what their market cap actually is today. But as they say, every investment, according, like, if you watch Everything Money, Paul likes to say, every investment is the present value of all future cash flow. So maybe their funds from operations are going really great and justify all of this. Well, that seems not to be the case, okay? So we have 2020, about 550 million in FFO. 2021, 655 million, and then 2022, an almost 30% drop to 460 million in FFO. And, you know, their footnote doesn't make me feel any better. The $197.4 million, or $194.7 million decrease in FFO for the year compared to 2021 is primarily driven by the overall decrease in total revenue. So revenue down, FFO down, assets down, shareholder equity down. So yes, the share price also, you know, is down some over the last 6 months, and also technically speaking over the last year, but it's still a premium, I think, when compared with the actual assets that they have in the company. So at the present time, I don't necessarily view this as like a value play. If you look closer at the financials and you think the dividend is sustainable and you just want the income, you know, more power to you. I don't necessarily think that's, you know, bad. But for me, I want value. I want a margin of safety. I want maneuvering space. I want room to run. And I just, on this one, I'm a little bit wary of it, and I would probably watch list this for about $15 or $16. And if it takes that kind of a hit, I would take a much closer look. But as it sits right now, I don't think I could do that. I don't think I could buy this. Just for my own objectives, it's just not looking like much of a fit. But, you know, if you have shares of this company, you know, feel free to tell me what I'm missing down below in the comments. And if you agree with me, give me a like. And if you want to be a part of the conversation and on an ongoing basis, I do have a Discord that's going to be linked in the description. Definitely encourage you to join. I think it'll be a good time. Take it easy, everyone. Have a great weekend.